The following is a presentation of TFNN.
Good afternoon, folks, and welcome to the leap year edition of our live webcast. We won't be doing another one of these for 4 years, so hopefully everybody's having a great February 29th. And, I forgot to wish David a happy birthday. So if you're in the other den, send him a quick message for us. So let's go ahead and begin. A lot to cover today. And our next webcast is 2 weeks from today on March the 14th at 3 o'clock Eastern Standard Time. I'm going to just flip through these couple quick slides here for all the new subscribers. One of the things that we do a couple of different things during this webcast. Some is taking a look at the celestial aspects. I recommend that you pick up a copy of the New American Ephemeris. You can pick this up here at Starcrafts Publishing. On the Celestial Charting webcast, if you go through some of the archives, we spend a little bit more time going over this information. Up here is really just the moon phenomena that we take a look at, and in the lower section of the ephemeris is the planetary alignments. And as I say, just if you go back and listen to either the one from 2 weeks ago or a couple weeks before that, there's, I believe, 17 hours worth of archived webcasts that you can listen to. And so go take a look at those. These are the primary lunar phases. The ones that we have been trading have been the full moon, new moon, quarter moons, apogee, and perigee. We're going to spend some time on apogee and perigee today, as well as spend some time on really just simply the candles. And just try to bring everybody up to speed on some of the candle formations. We'll focus on the hammer candles, and I've covered a couple of those patterns inside the newsletter. There's 5 primary major aspects, angles, I'll say, between planet alignment that we take a look at: the square, opposition, trine, sextile, and conjunction when the two planets are in alignment with each other. Again, if you please go back to the prior webcast where I speak about those. I don't want to do that in each and every session. These are the current March lunar dates. So tomorrow we will have a first quarter moon. The first quarter, third quarter, new moon really have not been acting from a trading standpoint as anything to put some weight on. The perigee and apogee absolutely have, and we did cover this last week, but I want to do and cover it again just simply because it's so important. It's working so well, and I have talked to a number of clients that have gone back and have mapped out a trading plan based on using this in the ES Mini. But you can use it for your trading as well. So I've got highlighted the primary lunar phases that we have been taking a look at. And as I say, tomorrow, Thursday, March 1st, is a first quarter. Then we have a full moon coming up on the 8th, on the 10th, which is a Saturday, which means it's either going to be the close on Friday or the open on Monday. That'll mark the point of perigee in this last lunar phase that we had traded. It happened to be the close of Friday's session. Also, with regard to lunar cycles, these are the remaining full moons. Again, I'm going to click through this quickly. You can get this off of the webcast from 2 weeks ago and a couple before that. These are the new moon phases. You've got the perigees. These are all of the perigees, lunar phases for 2012, so that you can mark these on your calendar and plan for it. And then all of the apogee phases, again, where the moon is furthest from us. I also have the moon when it's on the northern equator. Here are the first and third quarter moons for 2012. And then when the moon is on the southern equator. This here is the lunar trading strategy system. I don't think I'm including this in each day's newsletter. This was taken maybe about an hour ago or so. The SPYs right now are not trading right there. If I just take a quick look here on the SPY is trading out at 137.14. So really, and what really needs to happen, and we'll come take a look at it a little bit later, is being able to get inside the get inside these swing points here from February 3rd, in my opinion. And so the SPYs are quite a ways from that. I also did go ahead and put this slide together here. This is the 2011. I had this in not last week, but 2 weeks ago slide. And I did on this slide, I was able to convert everything to Eastern Standard Time. You'll see when I pull up the 2012, I didn't get a chance to do that today, but here is everything on Eastern Standard Time so that it becomes easy for you to go and lay these over on your chart. The yellow indicates that it's from the prior day. In other words, on just regular Standard Time right now, ephemeris time in Eastern Standard Time is a 4-hour time zone difference, so it's 4 hours earlier, and then during daylight savings time it is 5 hours. So I've made all the adjustments here. I did not make all the adjustments, just didn't have the time today before we got started, but you can make the adjustments. You can do a quick Google search, and perhaps next time I'll have this updated. But these are all of the going forward apogee and perigee one after another. So we're dealing with the one that we'll take a look at was from February 27th, a couple of days ago. And as I click to that chart right here, this is marked. This happens to be a 30-minute chart. So the high here, actually, if you went back and looked at 204, it happened to be the high during that first 30-minute session. This is 9:30 to 10, this candle right here. So right up at the top marks is kind of the line of demarcation. Again, this was taken a while ago. It wasn't actually at noontime, I don't think, but we can go back and take a look at it. And so if you were trading the SPYs, for example, what you would want to do, let's say you were maybe going ahead and taking a trade in the SDS, or maybe I think it's the BGU or the BGZ. I can't recall which one is the short side. You really, in my opinion, you wouldn't want to take the trade until you had confirmation that you were trading below this line here in the ES Mini. That's how I would take a look at it. And as long as you're trading above it, you should be long the ES Mini. And if the price is below it, you should be short. Or if you don't short, you should wait until price gets above it before you would take a long strategy. So all of those dates are in the system, or on the slides before, so that you can go back and you can lay that over your ES Mini charts and design a trading platform. I think that you do not need to use an average true range. We use the average 10-day range. In this case here, if you were trading a 30-minute chart, my recommendation is to make sure that you know what the average true range of the last 10 bars. And so, in the position size calculator, because we're utilizing daily information, we're using 10 days. It's really the same thing as using 10 bars. So if you were going to trade something on a 10-minute chart, or on a 5-minute or 15-minute or 120-minute, you just simply want to go ahead and take the true range of the last 10 bars just to give you an idea. I would recommend having to stop at least, I would give yourself at least what that average is if you decided to trade the futures, or maybe it was happening in this case here. Certainly at 10 o'clock or 10:04, you could have marked this line, and as you saw the ES Mini moving up, you could have gone ahead and taken a long position inside the SSO or one of the other vehicles. I've only laid this over on the ES Mini, have not laid this over on either the Russell or the NASDAQ, but it is working really well. And just quickly going back to take a look at the last, let me see here. Let me come here. So this is February 20th. Yeah, so this is the February 27th. This is the session before here, which, again, this occurred perigee on 2/11. You'll find out it was either a Saturday or a Sunday. And it looks to me like the best place to have really identified the line was right down here at the bottom. And and what you're going to use if you're trading these, if you're just going to use, you're going to use this to enter the trade, either the long or short. And what you would do is then, once you're in the trade, you would use normal exit points, or places where you would go ahead and adjust your stop. So in this case here, you can see really all that the ES Mini did was it completed a 100% move of a move by coming down into these swing points. So what you might do is you might take a look at this and do a reward to risk analysis and say, you know what, in this case here with Perigee being right here, knowing that you would be coming into 100% move, this may not have been worth the 5 or 6 points based on what the average true range was, and you might have waited for the ES Mini to get above line. But we'd have to go back and take a look further back to the left on this chart. But what I want you to understand is that if you are utilizing this system, what you want to do is you want to take a look at ABCs and swing points, if you will, when you're going ahead and trading this. Now, what I would do is I would use the average true range as a trailing stop as you get in on this trade, and that way, you let things run, and that seems to be the best way to maximize your return on this. So I'm going to quickly just go back, just so for those folks that are new or didn't get a chance to really take a look at the presentation from a couple of weeks ago, so that you can see, how well this is working. This was the January 30th aspect of Apogee. And again, this was the exact time on this. You can see here the idea of using the trailing stop certainly makes a lot of sense in my opinion. But this is just going to trade really the way that normal patterns that we take a look at. Move of moves A to B equals C to D, and you can see, although I don't have it marked here, you can see how close that resembles that. Then it moves sideways, and so that's why I say you can either go ahead and take your profits, or you can use some type of trailing stop and let the market take you out based on an average true range. I just simply showed on a 30-minute chart. It's just a little bit easier to see. And here, if we go back into the January 17th time frame, you can also see how, and it's working on both sides, if you will. Again, with the market trending up the way that it is, it's possible that you may just use this at this point in time here more from a long trade standpoint. So I'm going to go ahead and click through these charts here real quickly. But again, you can go back to last session and take a look at it. And then if you have any questions, obviously you can always either give me a call or you can send me a email. And I think I covered maybe about 18 of these slides here, taking a look at Apogee and Perigee, and it really is. I would say of all the indicators out there, of all the lunar phases, this one is really working well and works better intraday and works better on the ES Mini chart out here. I'll go ahead and I think I just have just a couple of more as we're going. So already back to September of last year, August of last year, and back into August. Okay, so what I want to do is just, and we'll just end this with August 2nd. So what I wanted to do today was to spend some time and field some questions and take a look at candles. So you know that on my charts, when I'm sending the charts included in the newsletter, or as we're taking a look at things on the radio show, that I use candles. I use candles often, and Tom doesn't use candles, so it's just all something that we're familiar with. So what I wanted to do is make sure that we use the same terms, the proper terms, if you will. And so when we're taking a look at a candle, what we're looking at is, in this case here, I'm going to use on the left-hand side, this marks the high of the session. So let's just say that when the market opens up, what you're looking at here, or on the next bar, okay, so it doesn't necessarily have to be on when the market opens up, just depends on what time frame it is that you're using. In this case here, a black candle. Now on my charts, it would be a red candle. So I'm using red and green, if you will, and I didn't get a chance to color things in. Sometimes people will just simply use black and white. So when I'm using a red candle, if you will, it means that this is where it opened up. And so red on my screen in the charting software is really referring back to a black candle here. So what you have is during this session, and I don't know whether this would be a 10-minute, and it really doesn't matter, 10-minute daily or what have you. So on red, it's where it opens. Where the bottom of the red would be on my chart would be where it closes. And then during that session, if this was a 30-minute chart, this was the high price and or the low price. The same thing over here, just simply that would be the green candle as I pop that up on the chart. And so what I do have up here on the chart is a daily chart. This is a daily chart of gold. as a matter of fact. And if you take a look at the daily chart of gold, you can see that gold opened up in the trading session today at 17. Oh, where was it? Where's the open? 1786.20. That's right over here is the open. I'll leave my cursor over it so you can see 1786.20. What you do is if you take a look at the trading session from yesterday, what you can see is gold closed at 1784.80. 1784.80 opened up at 1786.20. So this candle here had a higher body, if you will, and that once you do that, that can set up what would be called a bearish engulfing, depending on where this candle closes during the session. Now, what I do want to show you is that in gold and these candle formations, do send out a signal. In this case here in gold, it's sending out an absolute huge signal to us, because so far what you have done with this candle is you have engulfed 23 days. Now, the session, is not complete, and so you've engulfed 23 candles. That's over how many trade? That is 4 trading weeks. Over almost 5 trading weeks have been wiped out. Going all the way back to January 26th, so an entire month's worth of trading. And so I think that what we can clearly say now, I thought that what we would do is we would see gold get up into this 1804 area. It got up fairly close, obviously getting up to a high of 1790. But what this is doing, folks, is this is setting up what looks like a consolidation trading range, which is pretty nice, from the 1800s down to the low of 1500. And, we will start taking a look at ways to play the ETFs in gold, DZZ, both on the long and on the short side. But right now, if you are long gold, you should be pretty careful. And I will go over the details of the bullish and the bearish engulfing. But what I want to show you is just simply first from the candle standpoint, green on mine. Green means it opened up at the bottom and closed up at the top. Red opened at the top and closed down at the bottom. And this one is probably one of the larger bearish engulfing candles that I've seen in quite some time. So that is going back here just simply to the basic candlestick formation. So there's bullish and there is bearish candles out there. These are the primary bullish candle patterns that are out there. And the one that I wanted to focus my time on today, is a little bit of everything, but certainly that, I'm taking a look more so for hammers, if you will. Like hammers, I am thinking that even though the market is going up on light volume, until we see some of these trends really broken, and I'm looking at that ascending wedge, I'm really looking for this, unless there is some significant volume, to be a pullback maybe into that descending tops area, and looking for some real opportunity for some longer trades. But either way, you want to be paying attention to these candle patterns. Now, some really are more significant than others, and so we have hammer candles, inverted hammers. You've got here's your bull. So of the bullish candles that make the have the highest probability of working, and that you should be paying attention to, I would say the hammer. The bullish engulfing pattern. And the bullish engulfing pattern is only going to happen as the market is moving down. And we'll go take a look at some of that. But only as a market is moving down, just like in the gold contract, a bearish engulfing is only as the market is moving up. And so you don't want to confuse these candles. So in this case here, a bullish engulfing would be as the market is moving down, making a low, going from a swing point high to a low, and it is where the body completely engulfs the prior body. It can engulf more than one session, as we just saw with the gold contract. It does not need to engulf the wicks. So the top and the bottom of the candle, sometimes they're referred to as upper shadows and lower shadows. Because it's called a candle, I've just always referred to it as a wick. But they both are in fact, are the same thing. And the other candles, I do pay attention to this morning star, because it is a 3-candle pattern. And you have seen me mark those on the charts that I do send out. And then the windows, gaps. So you hear us refer to them as gaps. In Japanese candlestick charting, they refer to them as rising windows on the bullish side. So here are some of your other bullish candle patterns that are out there. And likewise, they have counterparts, which would be the bearish candle patterns. And on this slide here, I also have the neutral patterns that are out there. So when you take a look at the hammer candle, which is going to occur at the bottom, the opposite of that is what's called the shooting star, if you will, and that is this candle pattern up here. So shooting stars are something that I take a look at. The bearish engulfing patterns are something that I take a look at. And then you have the falling window. So we had the rising window for a gap up. You have the falling window for a gap down. And then I also, you've seen me identify evening stars because of this being a 3 candle pattern. And as I had pointed out yesterday and included a copy of the 1987 chart on the Dow, the doji candles. And they're neutral because many times you don't know if it is a halfway move up. What it does tell you when you see a doji candle is that, if it's you see that on the way up, it just simply means that the bulls are starting to lose control. Maybe things are getting a little bit tired, and you really don't have a confirmation until a candle or two later. And again, I didn't include 1987 and didn't, it's really a matter of looking at charts and trying to identify past trends to see if there was anything in there. And that's when I took a look at the highs that we were making and went to search for the next double doji that we had out there, and that happened to be May 2nd. And then that's when I said, let me go back and start searching, because it was relatively easy for me to scan and go back. And then when I came upon that in 1987, it made me say, even deeper, if you will, only from the standpoint of, hey, we just need to know. The only way to know where you're going is to know where you've come from, in my opinion. So when you take a look at a hammer candle, which is part of today's focus, there is what you'll call basic criteria and strict criteria. And in basic criteria, it is where you've got again, you're going to have a hammer in a downtrend, and it's really referred to as hammering out the bottom of a price move. The body can be black or white or green or red. It just depends on the what color charts you might use. Now, in this case here, let's just assume we're taking a look at this white-bodied candle. In my charting system, that would be green. What that means is certainly that price that the stock opened up right here on the bottom of the body, moved all the way down, and the bulls took over. And even though there was a bottom being hammered out, the bulls were able to take over during this session. But what's most important, and this is truly the strict criteria, so what you're looking at right here, this one in the upper left-hand corner, this is the strict criteria hammer. And I'm glad you asked the question, what's really the difference between a strict and a basic criteria? A strict criteria hammer, where you finish off the session at the highs, just simply has a better odds of working. Just based on studies. These are not personal studies that I've done, but these are based on studies that others that I trust in the industry, that they have done enough of the back testing, and I rely on them myself as well. So, when you're searching, when you're scanning charts, and this can be done on any type of chart, whether it is a futures contract, whether it is a currency contract, what currency pair, ETF, you want to pay attention to these. Now, when you're trading an ETF, such as one that might be dealing with the Asian stock market or the European stock markets, where you have all kinds of gaps, all kinds of windows, if you will, because of that, I haven't, just simply the way that those trade, I would be looking at this candle pattern on that index, not on the ETF. And I hope that makes sense to you. So it's just what you really want to do is understand the true underlying instrument. So what I'm saying is that if you were going to play like the FXI or the FXP, and you see a hammer there, what you really want to do is you want to go over and you want to take a look at the China 25 index to really understand if the same candle is actually there. So use the underlying index as much as you can. So that means if you're playing the spies and you see that hammer candle, go over to the actual index and see what candle formation is there. And hopefully if you're identifying a bullish candle in the spies, you're seeing a similar bullish candle in the actual cash S&P. But this is a strict criteria hammer, and the strict criteria hammer does not have any kind of wick or any kind of shadow above it. It means it actually closed at the high. And you'll see in some candles, some hammer candles, you will see a very, very long wick. The longer the wick or the longer the shadow, the stronger the candle. And if you have a strict criteria hammer and you have a very long wick, that is telling you that the trend has very likely changed. Now, what I mentioned in the newsletter and in trading these candles here, that what I have found is that if you can be patient enough and look for a trade in the 3rd to 8th day, that your odds of success are about 75%. Now, you will see, just like any big fish out in the pond, you will see some of these get away from you, but that's just simply trading. And where you want to try to pick these up is you want to try to pick these up anywhere between the 50% level of the shadow or the wick and the bottom. The preference is going to be trying to pick it up towards the bottom of that candle and get a test of it. You can this trading session, it doesn't matter what's trading session 3, 4, 5, 6, 7, or 8, can go ahead and dip below the shadow, but you want to see it close back above. And now what you would do with that hammer candle is you would use volume analysis or anything else that it might be coming against over on the left-hand side of the chart. And as I indicated in the newsletter, what I like to really do is if I'm trading the daily chart, I like to go down to the 15-minute chart and get a confirming signal. Now, there are other confirming signals that you could be taking a look at, and those are the Fibonacci numbers that we use. So a 0.382, a 0.786, maybe where you have two converging. Those are, in my opinion, just as good of a signal because they identify just simply what Fibonacci support and or resistance. In this case here, because we're talking about a hammer candle, it would be the support. And so you can use that as well as an area to go ahead and enter the trade. And this works on all time frames. And so if you are in front of charts or screens, active screens, I suggest that you look for these. And then once you've entered the trade, again, what you're going to do is you're going to use normal exit strategies in order to do your risk reward. Now, if you can imagine here, I'm talking about a candle like this where you're talking about letting it get down to the 50% area. That's going to give you a pretty good reward to risk. You're not having to risk a whole lot. Now, when you do get into this trade here, I still say that you need to be aware of the average true range. So I think from a position size standpoint, you still use the average true range. You don't have to use the 1.618 expansion, but you should know where it's at. You should be able to go to the position size calculator, understand what the average true range is, understand what that halfway point is, and take a look at. And as we took a look at the SEO trade that I had in there yesterday, I had identified where the stock had closed the session before, used the average true range, which would have as our stop, which would have brought it down below the actual wick. And still gave us the right reward to risk. But we were going to enter down at the bottom of the wick. So, so we just simply, I had a manual adjusted stop. And I can go over that in further detail. So now this is a hammer candle. Again, as far as priorities, if you will, this would be first priority. This would be second priority. Now, the wick or the shadow needs to be twice the size of the body. All right, so that is what identifies a hammer candle at the bottom of the trend, and the wick to the top. You shouldn't have much. You should have, it should almost look a little bit like this, if you will. Now, the reason why this is number one is because you finished at the highs. The reason why this is number two is because you finished very close to the highs. In this case here, this session, this would be, in my charting, this would be the red candle, if you will. So, you got up to the high, but still in this case here, the bears were able to push it down a bit. So you'd go 1, 2, 3, and 4 from a priority standpoint with regard to power, if you will, of the candle. But what you're going to use is you're going to use in essence, 3 to 8 trading sessions. So I said days earlier. That was just simply because the ones that we've been looking at on our charts here have been daily charts. But if you're going to use an intraday time period, such as a 10-minute chart, what you're looking at is the next 3 to 8 candles, with the hammer being 0. Okay, so the hammer is 0, and the next candle being candle number 1. So use the 3 to 8 session. You'll see as we go through a couple of charts here. And the pattern psychology is just simply that, you've had this last burst of selling because this is coming at the bottom. You have had some buyers, some bulls, if you will, step in. You've rejected lower prices, and, it's indicating a change in polarity or trend between the bears to the bulls, and in this case here, what it does is it erodes the confidence of in this case here, the bears, and a reason to start taking a look at for long. Now, when you see these hammer candles, you like to see them coming in, maybe as a test on the left-hand side against a bullish engulfing, or maybe see it coming into a retracement area. And as I said, the low of the hammer is support. A close below the low of the hammer says you probably ought to exit the trade. The trade was wrong. Take just a small loss. Doesn't mean that it can't start moving back in your direction. But what it does mean is that, I don't like to see a close. I don't mind a test below it, but I don't like to see a close below the hammer. When you close below support, then what you have to start looking for is your next support area. Again, on this chart here, again, the shadow or the wick, 2 times the size of the body, and it can have a small shadow or wick at the top. So 1, 2, 3, 4 in priority as you are looking for candles. If we take a look at our VLO is the ticker symbol that I just simply pulled up as I was scanning some charts from last night. This is a hammer candle, so this is a priority 2, if you will. As you can see, the wick here is twice the size of the body. This qualifies as a hammer candle. You can see this was the high price somewhere here in around $24.90. Here's the low of the day. You've got the open and the close. And if you were going to take a look at trading this, I'm not suggesting VLO. I haven't done enough of study on this, but you would be looking to enter somewhere around the midpoint. So how do you figure that out? You take a look at right here, the open. Take a look at the low of the session. Just simply take that difference, divide by 2, and you can either subtract it from the open or you can add it to the close. I just add it to the low. I just typically add it to the low. So hopefully that makes sense to you on the hammer candle. So that was VLO. Here is I'm just going to go ahead and pull over a currency trade, and so that you can take a look at this. So this is the Great British Pound, just to show you how you can also use this in trading. Now, as I indicated to you, when you go ahead and you trade a hammer candle, what you're doing is once you enter the trade, what you're looking at from an exit standpoint, or where you're going to run into some resistance, is just going to be the normal stuff that I teach and train you on, which is you're just simply, once you've made a move, unless you have just simply sliced up through that area with a wide range bar, or maybe you've got some real strong volume. Now, on the currencies, you don't know what the volume is. So on the currency, you start making a move, you start tightening up your stop and let the market take you out. Now, what occurred here, and it looks like what occurred here, what you had was a bearish engulfing. So even if you stayed in the trade here and you had tightened your stop up and you saw this was occurring, once you started getting down here, you could see that the run was likely over. What does this do? This makes a bearish engulfing candle, and where does it come back to? Comes right back down here to support. Now you can see here day 0, day 1, day 2, day 3. So you could have entered this on day 3 or day 4. As you entered this, in this case here in the Great British Pound, this gave us the signal that this was a good trade. Why? Because we had a hammer. You can see this was just a logical move, if you will, support area. And this candle right here happens to be a bullish engulfing. So, Brett in Golden, Colorado, hopefully this is helping you out with regard to details of bearish and bullish engulfing candles, because I've got them both right here on this Great British Pound chart. And what I want you guys to get comfortable with is you won't, it won't matter to you whether this is a currency chart, whether it's a futures chart, whether it's an ETF, because the formations work the same. And so when you see that transition, from my standpoint, that's actually a cool thing. Now, if I just simply stay with this Great British Pound here, and I was indicating to you that you want to be paying attention to just the normal things that we use in our trading toolbox. We use these retracement levels between swing points. And so when you take a look at in the Great British Pound, this and I take a look at major swing points, if you will, and taking a look at the chart, you can see in this case here where you had a change in trend. And so from this low to this high up here, this happens to be a 0.618 retracement area. From where the market makes a turn here from this low to this high out here, this happens to be a 0.382 retracement. So you've got 3 strong retracements coming together, because this here from here to here is a 100% move of a move. Now, what you also have out here is you've got another bullish engulfing candle as you're coming into this area. So, what I want you to do is I want you to use the 3 to 8 trading sessions. When you see it happen on session 3, session 4, as opposed to 8, consider it to be a pitch that's in your sweet spot, and go ahead and fire away using the hammer candles. This case here is an equity ARG, just simply going back into 2011. This is number 4, right? When we go back and we take a look at our priority of use of candles, when you take a look at this hammer here, this hammer is really this one right here. So this doesn't mean that it doesn't work. It's just in priority what you're looking for. You're always looking for the strength, if you will. And just the opposite, if we turn these around and we were taking a look at those shooting stars, you would use really just the opposite approach, if you will. I don't want to confuse you. So if we come back to ARG here, this happens to, again, be a valid candle. Session 1, 2, 3, 4, 5, 6. 6 came right down into the midpoint, if you will. And again, if you just used normal, I'm not saying that this would be, I didn't do the reward to risk on this to tell you not whether or not this would be a good trade. More so to be able to help you with the right side of the chart. If you were to have entered this, once you make that 100% move of a move, you have to start tightening things up. You have to start. You can exit the trade and just go ahead and take your profits, and look for some type of confirmation to possibly enter the trade to the downside. What do we have here? You have, once it makes a move, what does it do? It tires out with the doji candle, right? So the doji candle tires out, and then this obviously was a resting period. This was not the halfway move at that stage. If we take a look at another hammer candle out here, here is why I say when you close below support, just go ahead and get out of Dodge. This is from a couple trading sessions ago. VNO is the ticker symbol on this, and in the reason for just simply waiting the 3 to 8 days, it ends up proving itself to you. Just looking to be able to put the odds in your favor. There is plenty of trades out there, and whether it's dailies, and I will start including in the newsletter, I will start including hammer candles that occurred the prior session. And my scans include all 500 stocks in the S&P. They include every equity inside the direction shares and pro shares. They include every stock in the Dow, every stock in the NDX 100. And if I have enough time, then I will go ahead and scan all 2,000 stocks in the Russell 2000. But there's a lot of computing power and just simply time. But you will at least, you'll know that when I run the candle, it's taking care of the S&P, the Dow, and the NDX 100, and then the ETF, the primary ETFs that each of us trade, if you will. And I will start also looking to be able to add the currencies to it. But I'll make you aware of when I add the actual currency trades to it. I don't have the scanner set up to be able to do that. I do that visually myself when I'm trading the currency pairs. Now, here is a RIM. So this is fresh from yesterday, if you will. And so RIM showed up with a hammer candle. What you did have is you had this expansion. I haven't researched RIM enough. But when you take a look at RIM off of the bottom here, just simply if you go take a look, you can see that you did have a breakout on volume off of this bottom here. Looks like you have made a Gartley, and if we have time, it's 3:45. If we have time, we can go take a look at whether this actually was a Gartley buy pattern that completed here at this hammer candle. But as you know, it doesn't really matter to us. We would wait until days 3 through 8, and this is only day 1. This was taken, looks like it might have been taken at around, does it have the time up here? Just has the date, so it doesn't have the actual time. So I will include RIM in the newsletter as one of the candles. And that way you can keep it on your chart in case I maybe overlook a possible trade that's in there. But what you would like to do if you're going to take a trade on this, and I'm not necessarily suggesting this one just yet, is is you would use just simply normal exit strategies, volume patterns, and things of that sort when you start taking a look at the right side of the chart where you would get out. Here is one of the triples that showed up, GASX, and I think this may have to do with the natural gas contract. I looked at this once before, and I apologize because I don't trade this, but you did have a hammer candle, and again, so you can see this is occurring at a downtrend. So you have clearly a downtrend here. This was not a hammer candle, by the way, folks. This the wick or the shadow is not twice the length of the body. This here, and this is something that you do want to pay attention to, is you want to take a look at days 3 through 8 on this. Why? Because this is number 2 when we take a look at our hammer candles of preference of choice. You can see you have just a little bit of a wick at the top, and your entry point would be somewhere either at the bottom. So in this case here, if you were going to trade this, what you would ideally be looking for, folks, is on days 3 through 8 would be a test of this swing point. So you've got a swing point here. It's not a hammer candle, a test of this swing point on lighter volume that actually gets into this midpoint here, rejects this on lighter volume, and had come down and tested maybe even the low or somewhere here. And then where is your exit point? Where are you going to run into resistance? So you may or you may not want to trade this, but I'm just trying to give you what you would normally be looking for in a pattern that would be coming down to the bottom. Your problem here is you're running into a supply line in this candle right here. So you can see even where today's action, and I don't know where this has ended up, by the way, but you're running into just kind of a normal supply line for folks that happen to be inside that trade. So that was GASX. If we take a look at here is a hammer candle from a few trading sessions ago as I was taking a look at what I wanted to review with you today, and this was not included in the newsletter a few days ago, but here is a hammer candle. You clearly have a downtrend, if you will. Here's a hammer candle. You got the close below. That's why I say you get out of Dodge. What does it do? It gaps down, if you will. So in this case here, you would have you would have reduced, and you would have lost well less than 1% or 0.5%, whatever it is that you traded with, by going ahead and exiting it. Now, you wouldn't have taken this because this is day 1, right? So it's another reason why you go ahead and you wait for day 3. Even if something goes ahead and takes off from you, you still want to wait. Here's another example of one where you would likely want to wait. This is the FXP, and here is the hammer candle that occurred 3 trading sessions ago. I don't know where this is closed right now. Again, this was taken maybe an hour or 2 ago, if you will. So here is the FXP. But again, remember what I said. If you're going to trade this, you really need to be able to go access the, I believe the FXP is the Asia 25 chart. If you were going to trade the FXP or the FXI, I'm pretty sure it's the Asia 25, the China 25, I mean. Here is something that we may be taking a look at, quite frankly. And so I pulled this up as I was from my scans. I don't recall if I included this with the newsletter, but what do we have here? We've got our number 2 candle, right? So here is our number 2 priority candle, hammer candle, session 1, 2, 3, 4, 5, 6, 7, 8. Okay, so we could have taken the trade in essence in here. You're right in this range, and I don't know how this session is going to. I'm going to mark this down because we might switch over to it. We have about 7 minutes left, but WEC. Why am I also saying, folks, that this is something for us to take a look at? Can anybody look over to the left here? Somebody can type that in. Can anybody look over to the left here and give me an idea why we might want to take a look at trading WEC? And I don't even know what WEC is, quite frankly. It doesn't, the company, the chart, it really doesn't matter to me. I'm looking for the pattern. Anybody have an idea why we might want to consider this one with this hammer here holds and from a volume standpoint? Bullish engulfing. Absolutely, Neil. Absolutely. Look at this bullish engulfing here. Got a bullish engulfing at the bottom. It engulfs 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 sessions, almost like the bearish engulfing on the. So what I want you to get here, what I want you to understand is you're using the hammer candles as your indicator for a potential upcoming trade. What you're using is the 3 to 8 days, 1, 2, 3, 4. Day 4, when you came down into this area here, you certainly could have, been in this trade at this stage. What I like about here is we've actually tested the bottom of it, and we're rejecting it. Seems to be rejecting it on lighter volume. This too is a swing point, if you will, and we've got this bullish engulfing. So where would your risk need to be if you were to enter this trade? It would need to be underneath the bearish engulfing. So your risk on this trade here, your stop on this trade would really, because this is your next line of support, if you will. If we come over and we take a look at LLTC, you know that this is one that has been on my buy list because I wanted to be able to play this as it came back into the breakout here. So I have been watching this, and voila, what do we get? We get up at the top of resistance here. What do we get? We get a hammer candle. We get a number 2 hammer candle, if you will. And what I think we have setting up in LLTC is an ABC up. I have to go a little bit deep. I know we have an ABC up because it's included in the newsletter from a couple of days ago, if you will. So this has a really, if this works. So we have trade session 1, 2, still not good enough. 3, 4. I still want to see a pullback into this candle, on lighter volume, if you will, in trading the days 3 through 8. And what you'd love to be able to actually see is you'd love to see it come in here and close above the this support or resistance area. I apologize, this resistance area here. So that's on LLTC. One last one that I've got is HMSY. Don't know what they do. Here is our number 3 on our priority list of hammer candles. This one is a pretty nice setup when I came on, and you've got some volume here. So you can see that, and this looks to me like about 50% of support out here. Now, not a hugely liquid equity. These are millions here. You can see this one here a little bit disproportional because there was looks like about 14 or 15 million shares traded this day. So it's not that it's illiquid, it's but I'll be taking a look at HMSY. You can see you've got some nice formation, this nice wide range. You've got this window here. And you had a little bit of a breakout, and I don't know what occurred on this day. I'll look that up to see if I can find anything. So that's with really just a few minutes to go. I wanted to just open. There was a couple of questions, and it was one question. I apologize, and the one question was dealing with the bearish engulfing candle on crude. And the question was, why was I being conservative in taking the trade? And it really, and I apologize if I didn't express this inside the newsletter, it was in taking just simply a look at reward to risk on this trade. What I was looking at was being in this for, probably a few days, if you will, because of, when we take a look at the crude contract, as this open window here truly acting as a support area. And we didn't get all the way down into it, but the lows so far in the crude contract were rejected, and it even though from a pattern standpoint, the question was the other bearish engulfings actually were tested. They just weren't tested right away. If I go ahead and pull up the contract, but it just simply was a reward to risk. If this had not gapped up, if we didn't have this gap here, this open window, then and this is really indicating a strong area of support in this case here. So anyway, so that's I hope that answers your question, Ron, on that. And so what? Some other questions. Does it look like crude oil has reversed? Well, let's quickly go over, because I haven't looked at it for an hour and a half. Let's go to the crude oil contract. Here we go. Let's take a look at the daily here. And the answer, the answer's yes. I'd still really like it to, we've got the market trading now at 54. I got to go take a look at the dollar index and just what type of volume we have in there. So right now, with just two minutes or so to go, it's hard for me to answer that question. But you did reject. You absolutely did reject, this area, and so. I knew that this was going to be an area of resistance, and that's why I took it off of the trade list this morning and was looking for a possibility for us to actually go long. Any other quick questions that we've got out there? Okay. The entry point has passed us by like in born weight. Yes. Yes, I think so. I think so. We're in 4 trades right now, and I think from a percentage of our portfolios, if you're in all 4 trades, relatively invested, and just waiting for the market to give us some indication, folks. I can't tell you, it's more frustrating for me to write the newsletters where this ascending wedge, that we happen to be in, probably than it is for you to read it. But and I'm not looking for things to prove my point. But when you have divergences like we do, and you really pay attention to that summation index. There's that's just not right. There's just absolutely something, is astray. What you want to have is, and if you take a look at that summation index, if there's any one thing I hope that I've been able to teach you over the last week or 10 days, it is paying attention to the summation index, because you want synergy. You want to be trading in that direction, if you will, which was why I identified the XLE. I'll pull that up here real quickly. The XLE had that one tick down. That first tick down yesterday. It looks to me like I'll be investigating the XLE further here, because we'll see the summation index continue to move down, and this may be so. We may see a trade in the DUG, or I forget the other the triple that is out there. We just need the market to give. We're in the absolute weakest link out there, which is the IWM. So if the market's going to crack, we're in the right trade on that. So, folks, I hope this. I appreciate you joining us. I know there's a ton of folks that are, looks like several hundred folks that are going to be listening to the archive. Always feel free to contact me by voice, by email. Have a great day, and look forward to seeing any of you in Tampa next Tuesday and in Boston on Saturday. And those of you that I did get a chance to see in San Francisco or Denver or Spokane, thanks so much for coming out. Have a great day, folks.